Holy smokes everyone, it is time to brace yourself because the stock market crash has officially begun. We are facing another 2008 Lehman-like crisis right before our eyes, and we are in right now a global stock market meltdown and a global liquidity crisis. As I'm recording this, I am watching the markets. The Asia markets are getting smashed. The Hong Kong Stock Exchange is down around 4%. The Australian stock market is down over 2%. The futures in the US are looking like it's going to be a bloody open in the US stock market. Even safe haven assets like bonds and precious metals are getting sold off. Crypto is down because nobody knows how dire a situation we're in with what's going on in China with Evergrande and what it will mean if the second biggest economy in the world goes down. In this video, I'm going to show you the proof, the data, some new indicators that are screaming red alarm bells that are telling us a big stock market drop is just moments away. And unlike other crises where the central banks were able to drop interest rates to save the markets and print heaps of money, well, now they are facing a huge problem because inflation is getting out of control. They can't just throw more money at it because then that's more fuel on the fire for that. And they have no more room, no more ammunition with interest rate cuts. So let's not waste any time, everybody. Let's get into the data and the facts that proves a big stock market correction is coming. Because look at this, everybody. The stock market is undergoing a slow motion deterioration with pockets of shares down 20% or more. But after this, we're going to see this pocket of shares increase. Because what you have to know is what's going on in the stock market right now is the reason why the indexes like the Dow, the S&P, the Nasdaq are looking like they're not dropping that much. It's because the large cap, the FANG stocks, the Apple, the Amazon, the Googles, they're holding these indexes up because they make up a huge percentage of the index. But what we're seeing is the small caps and the medium cap stocks, they're actually getting hammered. And that's because they can't get these huge bailouts like these big corporations have. And they don't have access to the Federal Reserve's funding facility because they aren't classed as primary dealers. So we are already nearly in a bear market in the S&P 500. But most people just looking at the indexes wouldn't realize it. Because look at this, people. Look at this data. This is very interesting. About 15% of the big cap S&P 500 stocks are more than 20% below, so they're down over 20% from their 52-week highs. So when the stock market falls 20%, that is a definition of a bear market. But look at this, everybody. As we can see here, the S&P 500 mid caps, 30% of them are already down 20% or more. And the S&P small caps, I bet after the opening today, half of the stocks will be down 20% or more. But let's now get into the indicators, the warnings that are telling us a big correction is due. Look at these indicators, everyone. Have a look at this chart, everybody. The blue line is the S&P 500 and the red line is margin debt. Now, as we can see, when we go back to 2000, when margin debt peaks and when it starts to fall, look, the dot-com bubble burst. Again, in 2007, when margin debt peaked and it collapsed, so did the stock market. Again in 2018. And look what's happening right now. We've had this crazy speculation in the stock market, so people have made returns with their own money, but then they said, look, if I take 50% margin debt, I could make even more money. And now, in July, margin debt has started to fall. And now what are we seeing in the stock market? The stock market is starting to fall. And if we do get a big, huge sell-off in the stock market, this is going to trigger margin calls and it'll make the sell-offs even steeper and faster. Also, a huge risk for the markets right now. This week, the Federal Reserve is going to decide whether it will begin tapering its balance sheet or not, or tapering its asset purchases. And just to let me show you how much this affects stocks, let's look at this chart, everyone. So the red line is the S&P 500 index and the blue line is the total assets of the Fed, the ECB and the BOJ. And all these central banks are saying that they're likely going to taper. And as we can see, the stock market goes up along with the Federal Reserve and other central bank buying assets because it drops yields down on bonds and it forces people to take more speculative bets to get returns because they can't get returns on bonds with yields at 1%. So it forces them into highly speculative stocks, and also it devalues people's money, forcing them to take riskier bets. But we can see when they do start to taper, this is going to add more downward pressure to stocks. Another indicator, that is very important, everybody, is the price to earnings ratio. And as we can see, the only other time it was higher was in 2000 and in 2007. But look at this, everybody. Earnings alarm bells are ringing for the market, showing signs of fatigue. So what this means is valuations are way too high for companies' earnings. Also, with consumer confidence absolutely plummeting to its lowest levels in decades in the US, this is likely to drop companies' earnings. And this is just a simple economic stock market fundamentals 101. When companies' earnings fall down, the stock prices have to go down. Also, the reason why the stock market ran up so much was because stimulus checks. This boosted companies' earnings massively. But now stimulus checks are gone, and again, some people were making more money on unemployment benefits than before their jobs before the pandemic. But now unemployment benefits are ending. All the stimulus programs, not just in the US, around the world are ending, and this is going to be less money for these companies, and that means that earnings are going to fall, and that means valuations are going to have to fall as well. But there's so much more, everybody. The stock market is getting hit with risk after risk. Something I think the stock market is also worried about is increased taxes. We can see here the government wants to increase taxes to help pay for the $3.5 trillion infrastructure bill. And how they're going to do this, the proposal is to increase corporate taxes to 26.5% and also the highest income tax rate of 39.6%. This is just going to be another hit to companies' profitability. And this is something I think the markets are finally waking up to, that it is likely that it will be passed. Higher taxes for corporations, that means their margins are going to fall. What you have to know is about the top income earners. A lot of them are investors. So if they're getting taxed more, well then that's less money they can put into the markets. So again, supply, demand, less money going to the markets. The markets aren't going to see this crazy growth like they have seen over the past year. And everybody, another huge red flag, another bad sign for the stock market to say things are absolutely getting crazy is the Warren Buffett indicator. The stock market right now is 239% of GDP, which according to the Warren Buffett indicator is extremely overvalued. Now, on top of all of this, the pandemic still isn't over, which is having big consequences on consumer confidence and economic growth, and also business investment, because some businesses don't know if they'll be shut down again or not. But what is the biggest risk of all? Like I've been talking about, everybody, this situation in China, again, China is the second biggest economy in the world. Its GDP is triple most major advanced economies. And this week, we're going to find out whether the Chinese Communist Party will let Evergrande go down or not. If Evergrande does go under, they're going to have to discount their apartments and their projects heavily. There are over 100 banks and over 100 non-banks that have money lent to this. This is going to cause a liquidity crisis. It's going to cause the housing market in China to completely collapse. This is going to force investors to have to sell foreign assets to cover their losses. And this is going to cause ripple effects throughout the global economy because China has been contributing massively to global GDP. They've been consuming a lot of materials, especially from Australia. We're seeing iron ore in Australia right now is tanking. The Aussie dollar is tanking. So just like in the 2008 subprime mortgage crisis in America, it didn't just affect America. It affected the whole world. And the same thing will happen if we do see some kind of liquidity crisis, or if this causes a banking crisis in China. This could lead to another 2008-like global financial crisis. And so you may say, oh, that's okay. They'll just drop interest rates again. They'll just print money again. Wait a minute. Interest rates are at zero. They can't drop interest rates any lower unless they go negative, 10%, which I highly doubt they will. Also, there's something called law of diminishing returns. For example, if you print 100 billion, while during the next recession, if you print 100 billion, it's not going to have the same effect. You're going to have to print trillions. And what have they done in 2020? They printed nearly 10 trillion. So what are they going to have to do if we do face another global financial crisis? Print $100 trillion? What do you think that will do to people's confidence in the fiat currency system? People will completely lose faith in the fiat system, and some currencies around the world will completely collapse. So maybe the only solution is to let the free markets do its thing, let this bubble crash, and then rebuild from a more sustainable base. So everyone, That was just my thoughts and opinions and some data to show you the kind of situation we're in the stock market, some risk we are facing. What do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.